There was a time when the US presidential threat of fire and fury, images of anti-missile batteries in central Tokyo, and newsreel of children practicing nuclear drills might have nudged the Nikkei 225 more than a couple of percent to the downside. But that was before the Bank of Japan fell in love with exchange-traded funds, ETFs. There's no enigma wrapped in a riddle here. Last week, when Japanese investors might reasonably have been all aquiver, the BOJ was engaged in a potent onslaught of its own, a record-breaking spree in which it tucked away more than $2 billion of Japanese equity ETFs in just 52 hours. That piles into a BOJ share portfolio whose book value passed $127 billion at the end of June and is on track to envelop 3.2% of the TSE market cap by June 2018. Is there anything distortional about being the only developed market central bank to buy equities on such an astronomically huge scale? In short, yes. Quite apart from soothing things when the apocalyptic soundtrack is cranked up, the BOJ's $30 billion ETF spree in 2015 made that the first year since 1989 that the Nikkei posted a net gain for the year despite foreign investors being net sellers during that year. But the scale of this experiment is now prompting a new line of analysis as investors, and probably the BOJ itself, quantify exactly how big the impact on market function and sanity is or will be. One test has been to compare the performance of the Nikkei 225, which is used as a basis of many ETFs bought by the BOJ, with that of the JASDAQ, which is not. The influence, concludes a new academic paper, is significant. More complex, though, is the attempt to compare what the BOJ is doing now with what the Japan Joint Securities Company and Japan Securities Holding Association did in the 1960s, bodies that were established with the expressed aim of keeping the Nikkei steady and that were accused of massive price distortion, disruption of market function, breaking the link between GDP growth and market performance, and creating panic over when the holdings would ultimately be unwound. On that last point, there is at least some clarity in the 21st century setting. If the BOJ began selling off its portfolio at the rate of 450 billion yen a year, the pace it bought them under Governor Shirakawa, it would liquidate the portfolio in just 31 years.